Hello and welcome to the week ahead from the Financial Times in London. Here are some of the big stories we'll be watching in the coming days. US tariffs on steel and aluminum are set to come into effect on Friday. EU leaders are meeting to decide on a Brexit transition deal. And will the Bank of England raise interest rates? We'll find out on Thursday. Let's start in the US, where President Donald Trump's planned tariffs on steel and aluminum imports are set to come into effect at 1 minute past midnight Washington time on Friday, March 23rd. But this is unlikely to be the end of the story. The EU is scrambling to be exempted from the 25% tariff on steel and 10% tariff on aluminum. So too are other countries, including Brazil, Japan, and South Korea. Mr. Trump is taking action as part of a national security investigation and amid concerns over Chinese steel being dumped on U.S. markets. But a lot of trade experts think he's at risk of tearing up the rules set by the World Trade Organization by invoking a rarely used national security loophole. Here's our World Trade editor, Sean Donnan.
We are in the process of seeing what is one of the most radical trade actions that an American president has taken since the Nixon administration in the 1970s. This is an action that is ostensibly aimed at China, but China accounts for just 2% of U.S. steel imports. It is a minor player, and that's the result of targeted tariffs that have been put in place for years now on cheap Chinese steel. What history tells us is that actions like this often hurt more than they help. In 2002, when the administration of George W. Bush did something similar, although in a slightly more benign version of it, the studies that followed showed that actually the net loss for the U.S. economy was something around 200,000 jobs. And the U.S. administration very quickly, within 18 months, pulled the tariffs back. This time around, we don't know what the exact economic impact is.
Now, on the other side of the Atlantic, EU leaders are set to meet for a summit in Brussels to discuss Brexit, the future of the euro, and the bloc's plans to retaliate against U.S. tariffs. The two-day summit on Thursday and Friday will give leaders a chance to debate priorities for Eurozone integration. The bloc's 27 remaining leaders will also agree a mandate for Michel Barnier, their chief Brexit negotiator, so he can start discussions about the EU's future relationship with Britain, covering everything from trade to defence and security. This will be an important moment in the Brexit negotiations, with an agreement expected on the terms for a 21-month transition that gives businesses time to prepare for Britain's exit. Here's the FT's James Blitz with more on what the UK is hoping for from a transition agreement.
The big thing that the British want from next week's summit is a deal on the transition. They're very likely to get it. That will be very reassuring for British companies and European companies that don't want a cliff edge when Britain leaves in March 2019. However, there are 2 or 3 things that are going to concern companies still. First of all, this transition only lasts 21 months. That's not a long time. Many people think it will take 3 to 5 years to build lots of the customs infrastructure you need. Secondly, it won't apply to a lot of free trade deals that the EU has with countries like South Korea, Mexico, and so on. We've still got to wait to see whether those deals will be rolled over so they still apply to the UK when the transition starts. And finally, it's not a legally binding agreement. With the EU, nothing is agreed until everything is agreed.
And finally, staying in the UK, we'll find out whether the Bank of England is going to raise interest rates. On Thursday, the BOE's Monetary Policy Committee is set to announce its decisions made at its March meeting. The committee sent a hawkish message at its last meeting in February, saying rate rises were likely to come earlier and faster than previously expected. Market expectations are that rates will stay on hold this month, but are likely to rise in May, which is the next time the bank will update its economic forecasts. So instead, all eyes will be on the wording of the summary and the minutes of the meeting for any hint of a shift in the bank's stance. Here's Gemma Tetlow, our economics correspondent.
One of the main factors that the Bank of England pointed to in February when they sent quite a hawkish message about future rate rises was the fact that they could see signs of wage growth starting to pick up. And since February, we've seen the release of some official data that suggests that actually wage growth did pick up towards the end of last year, so perhaps adding some weight to that Bank of England line. The other significant development since the February meeting has been developments in the Brexit negotiations between the UK government and the EU. But we won't find out this week what the bank thinks that has done to the outlook for the UK economy, because they won't be updating their forecast this week. They won't do that until their May meeting, and that is why people are really expecting the bank to probably stay on hold this week and delay any rate rise until the May meeting.
And that's what the week ahead looks like from the Financial Times in London. See you again next time. soon.